Okay, we are live. Good morning, everybody. It's going to be started here in about 5 minutes. So take that little bit of time that you have before we kick off to get comfortable. This is the time usually when we're at our live events, we get to chat. Unfortunately, because of the reality of everybody being digital now, it's a little more difficult. However, we do have a chat feature on Zoom, which I'm sure at this stage of the game, now that everybody's become Zoom experts, you probably have some familiarity with the chat. So feel free to utilize the chat feature. One of our board members, Ms. Paris Moe, will be monitoring the chat room, especially for questions. So when we get to the Q&A feature of the presentation, we'll be accepting questions through the chat room. We've designed this specifically so that there's a lot of time for questions. Half of our time really is going to be dedicated to Q&A with Mr. Hatley, because we know that that's always popular, especially when you have an esteemed attorney like Rod Hatley, which you'll get to know here shortly, who you'll get to know here shortly, on board. So we're going to be kicking off in about 4 minutes. Try to figure out a way we can have some background music or something with this Zoom feature. Does it have that? Does anybody know? Can you like?
It'd be a great idea to add it, certainly.
Play some background music, or you guys can hear me chatter. For some reason, I guess it must be the business development side of it. I'm not used to having nobody talking it. So.
Yeah, this is the new normal, I think.
This is.
We could certainly look into it, perhaps create our very own playlist.
Yeah.
Yeah, solicit input from your members. What would you like to hear, while you're waiting to kick off the presentation?
I'm going to go ahead and kick off. How to own real estate for maximum protection. A little housekeeping. Attendees are in listen-only mode. However, you can chat and, as I mentioned, use the Q&A feature. Please use the Q&A box to submit your questions for the panelists. And again, we're going to be spending a lot of time on questions today. This webinar, by the way, is being recorded. It is being recorded and will be shared following the event. It will be shared following the event. You can also use reactions by clicking the chat and using the toolbar, as you can see at the bottom of my screen here, if you want to raise your hand, yes, no, go slower, things of that nature. Here is the agenda. For the first half hour, we are going to be giving the time to Rod Hatley, to the speaker, to present his topic. And then at the middle of the hour, we're going to try to open it up for as much Q&A as possible. We have a hard stop at 1 p.m. today, so we will not be going past 1 p.m. A little bit about the San Diego CCIM chapter. CCIM San Diego provides real estate owners, managers, brokers, lenders, and other commercial real estate professionals with a distinct industry advantage through education and networking programs, such as this one today, that promote the highest level of excellence, competency, and collaboration. And that's really what we're all about. CCIM, when you think about our global network, we're really focused on excellence, competency, and collaboration. When you see that CCIM pen, you know that professionals have gone additional distance in their training, as well as networking across the country, which is really beneficial with like-minded professionals. Again, this is a global organization, CCIM. There's folks all around the world now earning their CCIM credential. If you haven't looked into earning yours, please take a look. It's very, very beneficial and very helpful to earn the pin, so to speak. Our sponsor today is Mr. Rod Hatley and Hatley Law Group APC, estate planning viewed through the lens of asset protection, and he will be our speaker this afternoon. And of course, we really want to take a moment to thank our annual sponsors of the CCIM. You know, in this environment with COVID, it's been more and more difficult for organizations like CCIM, like some of the associations out there, to try to figure out how they're going to maintain the budget, you know, especially when we're limited on the number of live events and classes that we host. So we're just grateful that our sponsors are still there, still backing us and allowing us to provide this great information. And those sponsors include Chase Commercial Lending, Hex Solberg, Marcus and Milchap, Marsh McClinic Agency, Procopio, Seville's, our gold sponsors, of course, our CoStar, Exeter, Langford and Associates, Pacific Medical Buildings, SCS Engineers, and Slat Capital. And then our event sponsors are the Global Hotel Network, Pacific Western Bank, Port of San Diego International Airport, South Coast Commercial, and Voight Real Estate Services. Again, we're very, very grateful to have those sponsors continue to support us, especially through these unique and changing times. Okay, and before we ask our first audience poll, I'd like to introduce Ms. Paris Moe. Paris is a board member here with the local chapter of CCIM San Diego, and she is going to be handling and assisting with the Q&A portion. And my name is Doug Tabor. I am a rental housing broker here in San Diego County. I list and sell apartment buildings and rental properties throughout the county. And so we today are your panel. And of course, we couldn't do anything without Miss Ellen Ernst, who is managing all the controls in the background to make sure that we are able to complete this. And by the way, if we start running into computer issues, if the internet goes down, which has already once today for me, we will recover. Just be sure to reboot and check back in, and we will carry on with the show. So that's who we are. Now we want to take a moment and put a poll out there, an audience poll, and find out who you are. So we're going to introduce a poll right now. Please take a moment to complete the poll and let us know who's in the audience today. We are hopeful that we have a wide diversity of folks. We have owners, investors, developers, lenders, brokers, property managers, attorneys, other. There's always that other category. So let us know who you are in our first poll as we get started and get ready for our speaker. I love watching these polls, Paris. It's like a horse race. You're just kind of watching the bar grow and keeps going. So let's see here. All right. So primarily in our group, we have 40%. Wow, 40% owner investors. Welcome. 7% developers, 33% brokers. The broker community's out. Welcome. We're happy to have everybody here. And we, again, are looking forward to an excellent presentation. Okay. So we're going to pull that poll off of the screen. Maybe I have to do that. All right. Now, it is my distinct pleasure to introduce our speaker today, Mr. Rodney J. Rod Hatley, Esquire. Rod Hatley is a respected San Diego estate planning, asset protection, and attorney here in town. You know, Rod was a United States naval officer serving the Judge Advocate General, or JAG Corp. And, you know, I've known Rod for many, many years, and I thought it would be a great opportunity for him to come along and share some important subject matter. You know, these days with a lot of the uncertainty and also with the big transfer of wealth that is happening in our country and really around the world right now, it's always important to know when you have investment real estate, do you have it structured properly? Is it held properly? And what's the best way to hold those entities and structure for protection in the future? So at this point, I am going to pass the microphone on to Mr. Rod Hatley. Rod, the floor is yours. Take it away, sir.
Doug, thank you very kindly for that nice introduction. And folks, thank you very much for sharing some time with us this afternoon. My talk is really going to be very general in nature. And really, there's not much I can do in, say, 23 minutes, except to just kind of give you a 30,000-foot level view of the lay of the land out there as it is. So If you have specific questions, certainly feel free to raise those in your chat bar. We'll try to answer them as best we can. I know that some questions came in already. Ellen has shared those with me, so I'll be happy to address those as we have a chance to visit in our time together today. Next slide, please, sir. Okay, this is a disclaimer. I wouldn't be an attorney if I didn't have a disclaimer. So I'm not forming an attorney-client relationship with anybody on this Zoom call today. I am just giving you general information. It may or may not apply to your specific situation. Last line is an attorney should always be contacted with regard to any issue that you may have. So there's no way that I can possibly talk to a group of 50 people and be able to give them advice that's tailor-made for their specific circumstances. So I just have to put that up there, get it out of the way so that we can have a chance to visit and talk about the topic at hand. Next slide. Okay, why the need for asset protection? Well, really a few reasons here. First is we are a victim-oriented society. I hate to say that, but it's true. As I understand it, 40 million lawsuits are filed every year. And I think, you know, there was a time in America, and for some of the older folks sitting in on this call today, can remember a time where if you made a mistake or you weren't paying attention or what have you, and you got injured or hurt, you know, you just kind of sucked it up and said, okay, I'll be smarter next time. The reality is today we have kind of there's sort of the lawsuit lottery mentality that exists out there. And people no longer take responsibility for their own actions. It's always somebody else's fault. So I'll just sue them, and then maybe I can get some go-away money. Second, plaintiff's attorneys. Now, I'm not here by any means to disparage. I have wonderful colleagues who do a fabulous job representing people who have been hurt or injured as a result of the negligence or the intentional acts of a third party. These people do a wonderful job making sure that these people get justice and also get compensation. But there's always, as in any industry, just in the legal profession, we have unscrupulous attorneys. Certainly in the real estate profession, you have unscrupulous brokers and agents, et cetera. Those are the people I'm directing this comment to. So no need to get political here, but just know that there are unscrupulous attorneys out there that are looking to make a quick buck, and I think that's necessarily bad for all the rest of us. There's the expanding theories of liability. And here I'm talking about activist judges. Those are judges who bend over backwards unnecessarily, it seems like, to try to find a remedy or a cause of action where none really has ever existed before. And again, not to get political here, but we've seen cases where a judge just totally, you know, what happened? Did you just create law out of thin air? So these expanding theories of liability give, I think, clients a concern about whether they're properly protected because you might be in front of an activist judge. Years ago, I learned in law school that the law is what the courts will do in fact. So we have to be sensitive to that. The deep pocket theory, if somebody gets injured, I mean, for example, many of you, or at least a number of you may own apartment buildings. So I think it's the question of it's not the issue of whether you will be sued, it's when you'll be sued. And somebody is having a party on the property and somebody falls over a railing or falls out of a railing or whatever. You know, what are they going to do? Are they going to sue the person who held the party? No, they're probably going to go after, they may sue that person initially, but they're also going to expand the lawsuit to go after the person who owns the property because that's the person with the deep pockets. So that's who they're going to sue ultimately. And that's how they hope that they'll get compensation for their injuries. And then, of course, finally, increased notoriety. Again, this kind of goes back to the plaintiff's attorneys. These are the folks who, if they can build a reputation in town or in their local jurisdiction for being a hard-charging, really aggressive, take no prisoners kind of plaintiff's lawyer, then that can kind of work in their favor to exact a settlement from somebody who doesn't really want to go through the time and the talent and the treasure of a lawsuit and would just rather settle the matter sooner than later. So these are, you know, just 5 reasons why there's a need for asset protection, especially for apartment building owners and real estate investors. Okay, next slide, please. We're going to talk about these topics today, the pitfalls of individual ownership, Then we'll transition into the ladder of asset protection, and we'll hit on P&C or property and casualty insurance, corporation versus an LLC, and then finally, domestic asset protection trust. And then we'll wrap it up with an integration with your estate plan, because I think it certainly makes sense to protect what you've got, but also to be able to pass it on in such a way that it doesn't get eaten up in probate court. So anyway, Doug, next slide, please, sir. Okay, individual ownership. Now, I hope this isn't the case here, although certainly in my experience, I've seen people who owned real property, investment real property in their individual names. And, you know, we tried to talk them out of that strategy. Individual ownership is really the easiest, least expensive way to own real property. It's owned in your name and it doesn't cost a lot. You just put the title in your name, and it's relatively easy to do. But the challenge with that is you have unlimited personal liability to what are called inside creditors. That is to say, claims that are directed against the real estate. So what would be examples of that? Well, someone comes on the property and there's a slip and fall, or somebody's living in the property and there's a mold exposure, or perhaps there's friable asbestos that hasn't been remediated, or perhaps there's a youngster and it's an older building that hasn't been repainted or what have you, and this little one is eating paint chips off of the floor that later causes brain damage. I mean, these are all reasons why you would have liability, and this is what we call an inside creditor. This is something to do with the actual real property that's owned by the individual. Okay, go ahead. Next slide, please, sir. Let's talk now, transition into the ladder of asset protection, and we're going to kind of step our way up the ladder. We'll start off with P&C insurance, then we'll talk about whether you should own as a corporation or an LLC, and then finally wrap that part of the discussion up with a domestic asset protection trust conversation. And go ahead, next, please. Property and casualty insurance, and then next again, please. Okay, I always recommend to owners of real property, investment real property, especially if it's a commercial building like for example, an apartment complex. Always, always, always have good property and casualty, also known as P&C insurance, to protect against inside creditors. Now, having said that, here's the reality. Insurance is fabulous. I mean, for pennies on the dollar, you can protect against future claims. But two things to be aware of. The liability the coverage needs to be reviewed periodically to make sure that you've got the proper amounts of coverage, and your insurance advisor can help with that. And then, because remember, you know, there are limits to any policy. So if there's a lawsuit and they get the plaintiff or the creditor gets a judgment in excess of your policy limits, well, that can be a problem. Also, it could be that there might be an exclusion to the policy. So for example, perhaps there was an unpermitted or improperly permitted addition to a building, say an apartment complex. That might take you out of coverage. So someone got injured on the property, they were in that unpermitted or non-permitted addition or structure, and so now you don't have the coverage that you thought you had, and now you've got the personal liability because they're coming after you. So again, always make sure that you've got the proper amounts of coverage, and make sure that you don't have exclusions that will take you out of coverage. And in this regard, I always encourage folks, you know, it's a great idea to have an umbrella policy of liability insurance, because that sits over all the other insurance you have. So if somebody gets a judgment against you in excess of your policy limits, now there's at least another bucket of money to pick up and cover that addition. And working with a good insurance professional, they can help make recommendations on what a proper amount of umbrella liability policy insurance you should have. And one of the questions that was asked is, well, how much would it cost to have, say, $2 to $4 million of liability coverage, umbrella liability coverage? And my understanding and my experience has been, especially as I work with clients who have these kinds of needs, it's probably about a couple $100 a year for each additional $1 million of insurance. So if you wanted, you know, say $2 million, that's $400 a year extra, which is actually, again, pennies on the dollar for the amount of coverage that it can provide when you need it, okay? So I hope that that's helpful. Go ahead and let's move on to the next slide. We'll talk about, now we'll focus on corporation versus a limited liability company. So next slide, please. Corporations, it's not a good idea. In fact, I always tell people never put real property into a corporation. There are two kinds of corporations, if you didn't know. If you file a corporation, you file articles of incorporation with the California Secretary of State up in Sacramento, by default, it is a C corporation. And the challenge with a C corporation is, well, twofold. The entity, the corporation itself, has to file a tax return on its income. And then the shareholders who own that corporation, when there's a distribution made from the C corporation to the shareholders, well, that's a dividend. So that's a second level of tax. And so now you've got a tax at the shareholder level. So you have an entity level of tax and a shareholder level of tax. And again, it's not, why would you want to double up on your taxation? Most people seek to limit the amount of taxes that they're paying. An S corporation is a pass-through entity. Now, all S corporations start off as a C corporation, and so the folks who set up the corporation have to make an affirmative election to make that taxable as an S corporation. And you have, I think, it's 2.5 months within which to do it after you form the corporation. So, I think you should be working with either your attorney. I always recommend don't do this on your own because you can make mistakes. Always work with a qualified attorney or perhaps your tax and accounting professional. Make sure that you're getting the very best advice on doing this correctly, because it's a terrible mistake to do this on your own and then you find out that I don't have the protection I thought I had, or now I'm facing 2 levels of tax because I made a C corporation. I put that into effect. I never made the S election, and so now I'm getting the double whammy. Shareholders of an S corporation do actively participate in the business. So unfortunately, they can't offset their S corporation income with rental property losses. So what I recommend that clients do is always own your real property, your investment real property, in a limited liability company, which we'll talk about in just a moment. But the LLC is a much better answer. It's a pass-through entity just like the S corporation, but it's a much easier way to own the property. And if you really want a corporation, have the S corporation manage the business side of things, because the LLC is that pass-through entity that's owned and operated either as a general partnership or a limited partnership. We'll talk about that on the next slide. Next slide. Thank you, sir. What is a limited liability company? Well, it's an asset protection entity that's formed by filing articles of organization. Remember, when you file a corporation, you file articles of incorporation. For a limited liability company, you file articles of organization with the Secretary of State of your jurisdiction. Here it would be California. It protects against inside creditors. Remember, those people who have a claim against the assets inside of it, so the apartment building. It also creates very favorable and flexible tax consequences because it is a pass-through entity and you're not paying 2 levels of tax. There's not an entity level of tax and therefore ultimately a shareholder level of tax. All that goes away. So all that there is the members of the LLC. Those are the people who own the LLC. They just report it on their tax return, usually through a K-1. It can be either manager managed. So if you've ever had any exposure to a limited partnership, you have one general partner who has all the liability, and then you have the limited partners who are able to participate in the profits, but they have their liability limited to whatever their investment is. Or it could be a member managed entity like a general partnership, where everybody has a right to say how things should be run, and everybody shares liability. Okay. So if you establish an LLC in an asset protection jurisdiction, and this is a hint to what's coming next, if you set up an LLC in an asset protection jurisdiction, and there are 19 of them around the country, then you not only get inside creditor liability, you also get outside creditor liability too. So we'll talk about that next on the next slide. Now we're going to talk about domestic asset protection trusts, and go ahead, please. there are 19 jurisdictions around the country where you can set up, there's enabling legislation that makes it really easy to set up a trust in that jurisdiction. And so that trust, if it's properly established and also maintained, it really provides a nice firewall of protection around the assets that you put into it. So typically what I do in my practice is I'll establish a domestic asset protection trust in any one of the number of jurisdictions. I typically like Wyoming, but Nevada probably has the best laws on the books. But regardless, you set up the domestic asset protection trust. You also pair it with a limited liability company also in that jurisdiction. And so now you have protection not only from the inside creditors, but also the outside creditors too. What's an example of that? Well, let's say that I'll pick on myself. I'm driving home later today and I get a phone call and I get distracted. And before I realize it, I rear end somebody on the highway. Well, that's an outside creditor. That has nothing to do with my ownership of a rental property or what have you. That has nothing to do with that. So, and if I didn't have any kind of asset protection in place, then that outside creditor could go against my membership interest in the LLC that owns the real, the real property that I have. So setting this up the right way is really important. And I hope that we drive home the point that don't do this in a vacuum. Don't do it by yourself. Get good, competent advice on how to set this up. Let's see. And again, if we do it correctly, a well-established and a well-maintained asset protection structure like a domestic asset protection trust paired with an LLC to provide against inside and outside creditors will really level the litigation playing field. So now you're in a better negotiating position. And also, we want to make sure that we are getting inside the mind of the creditor. This is the person who has the judgment against us or is trying to get a judgment against us. Because attorneys who take on these litigation matters, typically, it's not always, but typically these are done on a contingency. So the attorneys are having to front the cost of all this litigation with the hope of a payoff later on. But if they realize, well, we could go after Mr. Smith or Dr. Smith, but this person really doesn't own anything. So why are we going to spend money to get a worthless paper judgment that we can't ever collect on? That's foolish. Now, sometimes there's emotion behind a lawsuit. And at some point, I think there has to be that meeting where you say, look, we can continue to spend time, talent, and treasure to go after these people. But, why don't we talk settlement? A hope of something is better than all of nothing. So that puts the defendant or the debtor into a much better negotiating position. And it's not unusual that these cases can be negotiated away for pennies on the dollar, and usually on the courthouse steps. Okay, go ahead. Next slide, please. Now we'll talk about integrating all of these things with your estate plan. Next slide, please. All clients should have an estate plan to, number one, avoid conservatorship. And what is that? That's a guardianship for a grown person. So I'll pick on myself. If I'm driving home later today, I get into a bad car wreck and now I'm mentally incapacitated, at some point someone's going to need my signature. The way they're going to get it is they put me in front of the probate court judge downtown. They say, Your Honor, this is Rod. He's incompetent now to manage his affairs. Please appoint me some third person to be his conservator. And so now they have to report to the court every 2 years. How am I doing? How are they spending my money, et cetera? And I'm in probate court. And we sometimes call that a living probate because I'm alive, though I'm not well. And I'm subject to the court's continuing jurisdiction until I either get better or I pass on someday. And also probate, because and part of why I do what I do now, I spent some time on active duty in the Navy JAG Corps, trying courts martial, representing the accused at courts martial. Really enjoyed that work. It was a lot of fun trying cases, but it was very reactive. Part of what happened was my father died with a simple will, and he had various assets, real properties, et cetera, commercial properties. And as a consequence, my sister and I had to go through a 7-year probate back in my hometown of Memphis, Tennessee. That's not what Dad wanted, but that was the practical result. Dad had leukemia. So at that point in his life, he's making emotional decisions. So I know that in his heart of hearts, he didn't want this for us, but because he was fearful, he did not make the best decisions to plan his estate. So as a consequence, we went through that. And I decided there has to be a better way to do this. So that's why I went and got smarter, got an additional law degree, on how to really provide great advice to clients to avoid this, the time, expense, and delay of probate court. I think the vast majority of clients are going to be better served with a revocable living trust, an RLT, or the initials that I'm using here, instead of a will. Because if you learn nothing else today, wills go through probate. If you have a will, you're going through probate. That's a ticket to probate court. If you have a living trust and you put assets into that trust, then those assets will never go through probate because those are exempted from probate because they're owned by a living trust. If a client does a standalone limited liability company, let's say they organize a limited liability company here in California, okay, just to protect against inside creditors, and that's perfectly great answer. You would want to transfer the membership interests into your living trust because those membership interests are valuable and those are probatable. So we always want to avoid that if we can. So that's the reason why to make sure that you're pairing your asset protection with your estate planning. And then last bullet point here, if we have clients who undertake to do, I'm sorry, go back one more time, I'm sorry. If we have clients who undertake to do advanced planning, say with a domestic asset protection trust, they should put most of their valuable assets, their growth assets, like that very valuable apartment complex that they own, put that into a domestic asset protection trust, okay? And then leave their day-to-day assets. So, for whatever they need for their day-to-day living expenses, a bank account, a brokerage account, et cetera, leave that in their revocable living trust so that they can pay their day-to-day obligations as they accrue. And with that, go ahead and to the next slide, please, sir. I'm at 1229, can't believe it. This is my contact information. I know that we'll start Q&A here in just a moment. But if anything I've said has triggered any questions that you might have and you don't get a chance to ask today, certainly feel free to reach out to me. Or if we do have a chance to answer your question, you want follow-up, please feel free to reach out to me. I'd be honored for a conversation, and anything I can do to be of contribution, I'd be honored for that opportunity. Okay, so we're okay. So Doug, I don't have anything else to talk about right now, except we did have some questions that came in. Probably a good idea to go ahead and take those now, or?
Yeah, we'll go ahead and take those questions now, Rod. And I got to say that was an excellent overview, incredible efficiency, and what was to be expected of a Navy man. I would caution you to be very careful when you're driving home today. Based on your examples, if you need us to send you an Uber, we will make that happen. Wonderful job. Now, what I would like to do is introduce our own Paris Mo, and Paris Mo is going to be asking you the questions that have been submitted by the attendees. Paris?
Hello?
Hello?
There you are.
Right. Yeah. Rod, it seems like you did a fantastic job addressing all the questions our attendees may have. We don't have any live questions submitted yet.
Okay. Well, I will take this time right now. There were some questions that Ellen had sent over earlier, and so I did some research, and I can share. I'll ask the question, and then I'll give you my responses. So just bear with me. One, I assume this person may be on the call today. Asked, as a commercial agent, what is the best format to incorporate as a self-employed individual to pay tax at a lower rate? Corporation. I think the question was corporation or LLC. The best way for me to answer this question is when I graduated law school, my degree was a Juris Doctor, or JD. I sometimes jokingly say that also stands for just depends, because that's really the answer I give to a lot of the questions that clients will ask me or prospective clients will ask me. And really the answer here is it really depends. If an agent is an independent contractor with a major real estate company, and they're not focused on growing their individual business, usually they'll operate as a sole proprietorship. I mean, that's one way to do it. The owner is the manager and only partly liable for any legal issues. Income tax rates can be higher, but the only taxpayer is the owner. It's the simplest form of business entity, and it can work well for small agencies. Now, that said, an LLC can be an excellent choice where multiple sales personnel will be finalizing transactions. LLCs, as we've seen, have a general manager or owner, while the other agents are limited in their liability. And this establishes the LLC as a pass-through entity for tax purposes. And it also allows the owner to designate commission rates. Since the LLC is a pass-through entity, it doesn't pay any tax at its level. All of the members of the LLC will pay tax at their individual rates. Now, an S corporation allows for the establishment of benefits and retirement programs for employees and management officials alike. That said, the reporting rules and tax liabilities are more stringent, so it wouldn't be right for the smaller real estate agent who is not focused on building a major agency. So again, the best answer is always, if you have an accountant or a tax and accounting professional, I'd be sure to talk to that person. You know, the way you're set up, you know, should you change the way you're operating and doing business? Perhaps you're a sole proprietor, and maybe that's the best answer. However, depending on what your goals are, that may not continue to be the best answer for your situation. So by all means, make sure that you reach out and have a conversation with your advisors. The second question that I received was, does historical recapture of depreciation still occur under the new tax regs? From what I've seen, it does. And here, when we talk about depreciation recapture, that's the gain that is realized on the sale of depreciable capital property that must be reported as ordinary income for tax purposes, okay? And it's assessed when the sale price of an asset exceeds the tax basis. The difference between those figures is thus recaptured by reporting it as ordinary income. And there is an Internal Revenue Code section 1250 that really addresses this. As I understand it, because the IRS mandates that owners depreciate all post-1986 real estate using the straight line method, then the treatment of gains as ordinary income is relatively rare. And if an owner disposes of property as a gift at death, where you get that step up in basis, or they sell it as part of a 1031 exchange, or they dispose of it through some other methods, then my understanding is there are no possible taxable gains. So it's an interesting question. I don't think it has any real, anything that should concern the attendees today. But again, before you sell a property, make sure you brought your team together, your realtor or your agent. Make sure that your tax and accounting person, as well as possibly your attorney, are all involved in this, especially if you've done some estate planning. Bring your estate planning attorney into that conversation. Let's make sure that we get the entire team together so that we don't leave anything to chance, because getting an unexpected tax bill, that's no fun. So let's make sure we get out ahead of that and avoid surprises. Somebody had asked about intentionally defective grantor trusts and grantor retained annuity trusts regarding asset protection and ongoing tax reporting. That's a great question. I don't see a lot of those. This is really, I mean, I have handled those kinds of entities in the past, but I don't see a lot of them necessarily with real estate investors. But certainly if somebody has amassed quite a portfolio of very valuable properties, then in what we call an IDGIT, that's the intentional defective grantor trust, that's the acronym IDGIT, or a GRAT, that's the grantor retained annuity trust. Those are really advanced planning vehicles, and they can have a lot of value. It just depends on, again, what the client wants to achieve, what is their end game. Both of them are great asset protection vehicles because they are irrevocable trusts, and it would be the rare case, though, where somebody would need either or both. As for tax reporting, the typical IDGIT is a grantor trust. So it's an intentionally defective grantor trust. So income is taxed to the grantor, and that's a good answer. It's intentionally defective for income tax purposes, but it is effective for estate tax purposes. So someone who is looking at possibly having to pay or have their family pay an estate tax after they're gone someday, an IDGIT can make a lot of sense because it allows the grantor, the person who set up the trust and funded the assets into it, like the apartment building, it allows them to pay the tax at their individual rate, but they're getting the asset out of their estate, right? So there'll be no estate tax. And here's the big idea. every time the grantor makes a tax payment of the income taxes at their individual rate, they're adding more value to the asset that's going to the ultimate beneficiaries, whether it's children or grandchildren, et cetera, because they're not having to take assets out of that or money away from that asset in the IDGIT. Likewise, a grantor retained annuity trust, or the GRAT, if it's properly structured, it's treated as a grantor trust for principal and income tax purposes. All income, gains, losses, and credits are taxed to the grantor. And income tax payments by the grantor are not treated as additional gifts to the trust. So these are great planning strategies. It has to be for the right client, though. I wouldn't put everybody into either an IDGIT or a GRAT. It has to be for the right client, for the right reasons. But if it's a good fit, I mean, it can be a really powerful way to get assets out of the estate. And we don't have the ability during our brief time together to go into any depth here, but just know from a 30,000-foot level view that this is these are great planning opportunities, again, for the right clients, depending on their ultimate goals.
Those sound like really complex questions, Rod. And just as a reminder to everybody, we are going to send out Rod's contact information. So if your question is very complex like those, you will certainly be able to reach out to him. It looks like, Parrish, we have a couple of questions that have come out of the chat area. Do you want to ask Rod a couple of those really quickly?
Okay.
Yes, sure. So one of our attendee owns a beach home that's being now operated as a rental, and he's asking what would be a good ownership structure if he may move back into it later.
Wow. Okay. I would think, well, I guess it just depends. I mean, I guess it depends on how soon they may be moving back into the property. I mean, if they want to keep it as a rental, I would always recommend build a firewall of protection around that property and create an LLC to put it into and hold title to it. But then make sure you put your membership interests of the LLC into your living trust, so those membership interests are never probated when you pass on someday. If it turns out that this is going to be a long-term rental, then probably an LLC is a perfectly good answer for that. And then if ultimately you decide, you know what, we really want to live at the beach again. So, then you could, I guess, if you're going to live there as your residence, then, perhaps you terminate or dissolve the LLC that owns that, but then set up an LLC that owns your present residence, because possibly you want to set that up as a rental too. It just depends on what your ultimate goals are. But my initial impression is create an LLC, build a firewall of protection around the asset, and then you pay your $800 a year franchise tax board fee, which is really a pittance compared for all the potential protection that you're being afforded by the LLC structure. And then as circumstances change, it's not irrevocable, so you can always tear down an LLC. You can just dissolve it, file paperwork with the Secretary of State, and you're done. And hope that helps. Other questions?
Thank you. So the other question is, could you please talk about the cons and pros of LLC versus family limited partnerships?
LLCs and family limited partnerships, now we're getting, these are really advanced planning strategies. The family limited partnership, this is if you want to start moving assets out of your estate, but you want to stay in control. In my own practice, I don't see a lot of family limited partnerships. They still exist and people still use them. It's the idea of if we could, and the best example I can give you is, let's say that this is a very valuable bottle, okay? I mean, it's not, but let's say, it was like some kind of Wedgwood, all right? And let's say that it's very valuable, it's one of the oldest Wedgwood, bottles around and very valuable, et cetera. But let's say that I broke off like a piece of it, maybe not as valuable as it used to be. Still valuable, but it's just not as valuable as it used to be. That's the whole idea behind a family limited partnership, because what you're doing is you're taking a valuable asset and you're starting to get membership interest out of your estate. But the thing is, it's not marketable, and it's lack of marketability and lack of, let's see, there were a couple of discounts that you get. The goal is to try to, I'll say it this way, and this is really going to sound corny, but when I explain this to clients, it really tends to resonate. It's the concept of squash, push, and pop. What we're trying to do is take an asset, squash down the value of it for estate tax purposes, push it through the net of estate taxes, and have it pop on the outside. So that's the whole idea behind using a family limited partnership. You take an asset, you start gifting out interests to minority shareholders. So you get a lack of marketability and lack of control discount for estate tax purposes. So now you've squashed down the value. You get it out of your estate, push it through the net of estate taxes, and it pops on the outside. So all future growth and appreciation is outside of your estate. Now, LLCs are just basically a way to hold assets. I mean, there's no discounting that you get with an LLC, but you really get that with the family limited partnership. So that can be a really valuable consideration if we're trying to move assets down to the next generation. So I hope that that's a helpful 30,000-foot view of what the difference or the distinction would be between one or the other.
Thank you, Rod. So last but not least, we have a question on do trust companies commonly administer family trusts?
They can. It would depend on, trust companies, they get paid a percentage. So that is a decision that has to be made by I call them trust makers in my practice. I mean, you can call them grantor, settlor, or trustor. In my practice, I call those people trust makers because that really seems to resonate. These are the people who made the trust, so they're trust makers. The trust makers and also their attorney, their estate planning attorney, ought to have that conversation. Whom do we choose to be the successor trustee of our trust? Now, sometimes a corporate trustee, like a bank or like a trust company, can be very valuable possibly as a backstop, or maybe because the parents, the trust makers, they know their kids would fight, and they want to try to ensure family harmony as much as possible after the survivor of them has passed on. They might just say, look, we love our kids equally, no doubt about that. We don't love one more than another, but there's no way we're ever going to put our kids in as the trustees because we don't want them to fight. So it might be a good idea to choose a corporate trustee to serve as the trustee to administer the estate after the successor of a married couple or the trust maker, if it was just a single person, has passed on. Sometimes that can be a great backstop. So maybe they choose oldest son or oldest daughter, and then they go down the line. And then if none of them want to serve or they can't serve, just because you've been nominated to serve as a trustee doesn't mean you have to serve. Then you've got a corporate trustee as a backstop. But again, they charge a significant fee for what they do, and they should because they're good at it, and they also have to insure themselves so that if there's any misappropriation of monies or whatever, they can make the beneficiaries whole. It just depends. It depends on what the clients are comfortable with. And if it's a large enough estate, where it makes sense to have a professional trustee come in and handle that, a corporate trustee, well, then sure, that makes a lot of sense. And usually most people, especially as the estates get larger, they probably don't have the expertise and probably don't have the time to handle these day-to-day details. So it can make a lot of sense to have a corporate trustee put in there someplace.
Rod, that is a very common concern among many of the clients that I do business with.
Sure.
And unfortunately, if I had a $5 bill for every sibling relationship that got torpedoed and exploded over an inheritance,
sure.
I'd be a rich man. And it's really sad. It's a funny statement, but it's very sad that happens. Is there any experience that you've had, or maybe you have some recommendations to those that are thinking about how they're going to pass on their real estate assets to the next generation? I mean, do you recommend that they break them up? Do they try to put them in the trust and then make the trust so it's easier to divide?
Yeah.
What has been your experience?
Yeah, great question. And I think it just depends on what the clients want to accomplish, what's important to them. And that's really a counseling issue. And so as I sit down with clients and they may have rental properties that they've amassed over many years. They have a really nice portfolio. They may just be of a mindset to say, you know what, look, none of our kids has an interest in running these things as an apartment complex. Here's what we want to do. We want everything sold and then have the proceeds split however many ways that we have, beneficiaries. Or, this is where we made our wealth and we don't want our kids to sell this. We want them to continue to have an income, but we're going to limit, what they can do with that income and, put some restrictions in place, et cetera. So it will ultimately depend, Doug, on what the clients really want to achieve for themselves or their families. I've seen cases where, the client said, look, when we're gone, we don't care. They can either continue to operate say it's an apartment building, they can continue to operate it, or, they can just sell it and then split the proceeds. It just depends on, and typically the clients, they know who their kids are and they know what the kids would probably do. And so they'll either, acquiesce to that, or they may just say, you know what, we worked really hard to build what we've got. This is important. We want this to stay in the family if possible. And we want there to be, a division of the net income that is thrown off by these properties, because you couldn't get this property, you couldn't buy this land, you couldn't get this land again in San Diego for any price. So we certainly don't want to see them, blow this opportunity, because this is a very valuable property. It will continue to appreciate over time, and keep renovating it, keep it maintained properly, et cetera. So again, it will depend on what is important to the clients.
Sure. Earlier on in your presentation, you mentioned using an LLC for holding the property, but then you also said utilizing some sort of corporation, an S corp or something, to manage the business side of that. Could you expand on that a little bit? Because would that be just one property, or if that's someone that has multiple properties?
I always think it's a better idea, because in my experience, what I found is people, for example, recently I worked with a dentist who had his owned the building in which his practice was located, and he put that into a C corporation. Well, that's a tax no-no, because you have to, he's going to pay taxes on that if he were to dump it out of there. So he would have to transform that C corporation into an S corporation, wait 10 years, and then he can take it out without incurring unnecessary taxes, capital gains taxes. So it makes a lot of sense to avoid all that by having the property itself owned by the limited liability company. It's a pass-through entity. It doesn't have the strictures that an S corporation has. And also, I think it's to do with because the folks who actively manage a property, they can't, because of the active management, they can't take rental losses from the properties against their income. So, because it's active and these losses are passive. So the goal is to, match up the right income with the right losses. So since that's really the determining factor here, the goal is, have the real property owned by the LLC. And then if you want to manage the property, you use an S corporation for the management, so that the income and the outgo, et cetera, and the profits and losses, et cetera, are in the S corporation, not in the LLC. Hope that helps make it a little bit more clear.
Sure.
And again,
it doesn't look like we have.
I always recommend, work with a good tax and accounting professional, somebody who does this regularly. Doug and I both know great people who would be honored for a conversation on how they can structure you the right way. I hate to see people make a mistake on owning the property the wrong way and not getting the best bang for their buck in terms of their income and write-offs, et cetera, and setting up the right kind of profit sharing, et cetera. So work with people who do this regularly. I mean, I look at the big overview, but I don't prepare tax returns and I don't get involved with compliance. I really help clients on the transfer tax. That's estate, generation skipping, and gift taxes. I don't do personal income tax returns, but I know enough about it to know what the issues are. But then I always say, go see this person who's a good CPA and does this regularly. Hope that helps.
Certainly. Seek out the expert. Sage advice.
Always.
Paris?
Yeah, we are seeing another question that comes in. It sounds like that California is now one of the jurisdictions that allows for debt. Is that correct? And we would also like to know if you can combine a California LLC with the debt from another jurisdiction?
Okay, great questions. As far as GAAP is concerned, as I say, I don't do tax compliance, at least income tax compliance. I would be surprised if California does not observe GAAP, and GAAP is the generally accepted accounting principles. I don't know that California does not do that. I suspect that they do that, but if there are differences or variations, I could not say. Again, I don't prepare individual or corporate income tax returns. So again, that's a great question for your CPA. And I always encourage people, talk to your CPA about your specific individual situation. As far as combining an LLC with a domestic asset protection trust, say in Nevada or Wyoming, which is one of my favorite jurisdictions, but again, you've got 19 of them around the country. You can do that, but here's the problem. The problem is that a California limited liability company only protects you as against inside creditors, okay? So it will be more valuable. Now, if you've got an LLC in California, you can transfer the membership interest into either a Nevada or a Wyoming LLC, because now you're getting two levels of protection. You have the larger outer wrapper of the domestic asset protection trust and the inner wrapper, if you will, of the limited liability company situated in either Nevada or Wyoming or any of the other jurisdictions where they have the enabling legislation. In California, all we can protect against is the inside creditors, okay? So as I say, if I rear end somebody on the drive home tonight and all I have is a California LLC, well, that's not helping me as against that person that I hit on the highway, okay? But if I have a Wyoming, let's say a Wyoming domestic asset protection trust, and I have a Wyoming LLC that owns, say an investment account or whatever, then that's a great answer, because now I've got two levels of protection, and I protected myself not only against the inside creditors of any rental building that I own, but also as against outside creditors, somebody that I happen to hit on the highway through my inadvertence or negligence or what have you, okay? So while you could do it, I don't know that it's really all that helpful. Again, I think setting up a limited liability company along with the DAPT in that jurisdiction that allows you to do that, and then transferring the California LLC membership interest into that LLC in Nevada or Wyoming or wherever, that's a much better answer, because now you're getting the inside and outside creditor protection in that instance. Hope that helps.
Rod, excuse me, I wanted to correct myself just now. The attendee was asking about whether California is not one of the jurisdictions that allows for domestic asset protection trust. I believe you were addressing.
Yeah, it is not. Yeah. Unfortunately, we're a very creditor-friendly state, and that's just the way it is. So if you want to protect yourself, you've got to go to a foreign jurisdiction. And when I say foreign jurisdiction, I don't mean Canada or Mexico. I mean Wyoming or Nevada. That's a foreign jurisdiction, and that's just the legal term we give it. But California doesn't offer any asset protection at all, except for if you set up a limited liability company with the Secretary of State up in Sacramento, you're getting protection against inside creditors, but that's it. If you want inside and outside creditor protection, you've got to go to a foreign jurisdiction like Wyoming or Nevada, what have you, okay? Hope that helps.
Thank you, Rod.
Rod, it doesn't look like we have any additional questions from the chat room. We maybe have one more time for one more question as we're coming close to the hour. Do you have any additional questions on your sheet there?
Yes, I do. Actually, I've got two, and I think I can probably hit both of these in the time remaining. What are the setup and yearly costs for an LLC? Would you recommend one for each property, and the level of umbrella insurance to get, say, $2 to $4 million of coverage? Very simply, an LLC is formed in California by filing the Articles of Organization with the California Secretary of State. You pay a $70 filing fee, and then most businesses would also pay an $800 a year franchise tax fee. And then in addition, within 90 days of filing your paperwork, you have to file what's called a Statement of Information and pay a $20 fee. So it's fairly inexpensive, but having said that, the real bang for the buck is having a good operating agreement. So just filing your Articles of Organization is important. You have to do that. But if you don't have an accompanying operating agreement, which sets forth the rights and the responsibilities, that can be a challenge because what if there's a fight between the members of the LLC? So you want to make sure you work with an attorney to get that in place. You can always follow the articles of organization yourself, but you really do need to have a good operating agreement. Question is, should you have an LLC for each property? I would recommend it. It just depends on how much the properties are worth. I mean, this can get rather expensive after a while. So it probably makes good sense, I think, to build a firewall of protection around each of these different real properties or these rental units that you own. As I already mentioned, liability insurance, roughly $200 a year for each $1 million of coverage. So if it's $2 million, it's $400. If you want $4 million of umbrella coverage, that's 4 times 2. That's $800 a year, less than $1,000 bucks, you know. And again, this is pennies on the dollar. Last question that had been sent ahead of time was, what is my opinion of California's experiment with the transfer on death deed? I think it was a great idea. I know that a lot of folks out there, you know, of modest means, and hiring an attorney can be an expensive proposition. So it was an effort by the legislature to say, you know what, let's give the average person the ability to leave their real property to whomever they want without having to go and do a will and a trust and stuff like that, which can get expensive, no doubt. So this was effective January 1st of 2016, so 4.5 years ago. And it just allows that property to be transferred upon the owner's death to whoever they designate, and it avoids probate, which is a good answer. And all they have to do, the person who's inheriting it, all they have to do is provide a copy of the death certificate and file that with the county recorder's office, and the property is now their property. They didn't have to go through probate to get there. What's my opinion of it? I think it was a great idea. I don't know how successful it has been, but certainly anything that allows the average person to be able to plan their estate without having to incur, you know, fees, et cetera, I think is a good answer, but I don't know how successful it's been. That's all I can tell you.
Rod Hatley, build a firewall around your assets. I love it. Thank you so much, Rod Hatley of the Rod Hatley Law Group. We really appreciate your expertise today. And on behalf of CCIM San Diego, Doug Tabor, Paris Moe, and all of the attendees today, thank you so much. We look forward to everybody joining us next month for our next event. And again, we're going to be sending out a survey along with Mr. Hatley's contact information and a replay of this event to each of the registrants. So be on the lookout for that. And everybody have a wonderful day. Stay safe, stay healthy out there. Bye now.